Hello and welcome to the Moving Market Podcast. I'm J.R. Gondeck, as always, joined by David Sokolovsky. David, let's recap August and kind of look ahead to the Fed meeting in a couple weeks and the rest of the year.
Sure. Thanks, Jared. So August was an interesting month. It was strong performance really across the board. But some of the things that we started to notice are the things that we've been talking about, which is, a little bit of a rotation from growth to value. And you saw value have a very strong month and continue to outperform. The S&P was up about 2%. And again, a lot of that driven by value names. And another interesting area of the market was the small cap stock index, which was up 7% for the month. And I think that's interesting and ties into a lot of the conversation ahead because I think a lot of that performance really came on the hopes of lower interest rates. It looks like, in August, Chairman Powell indicated that rates will be coming down in the near term, depending on labor and inflation. We've seen that inflation has remained relatively balanced over the last couple months. But labor is where a lot of the concern is and where we'll spend a lot of our conversation. But as we look ahead to labor potentially weakening, we do expect to enter an era of rates moving lower for the foreseeable future. The question is, how far do rates move? What happens to intermediate and long-term rates? And what's ultimately the impact to the overall economy?
David, let's turn my mentor and founder, Gene Lerner, used to say, where are we, right? And I think it's a good, transition, looking at the economy, looking at inflation, looking at employment, where are we and where are we going? So I think if you start with GDP, looking at second quarter, over 3%, at this point was the number for the second quarter. Now, as we're looking ahead to third quarter, here's the projections from the Atlanta Fed, solidly right around 3% again. So it could move around with a few weeks to go in the quarter, as we've seen in past cycles. But in general, it's hard to see this going much below 2%. So you have back-to-back solid, growth in the overall economy. Now, as you look at inflation, again, we've had a number of months of positive reports. And if you look at kind of all items at this point, and you look at the last 6 months, we've been trending toward less than 2% GDP as you take the last, 6 months and annualize them. You still have some big numbers from earlier this year and late last year to cycle through. But as the Fed looks at the data, GDP, decent, inflation, moderating overall. Is there some concern with service inflation last month and some other things? Potentially. But then the big thing, as you said, is the labor market. So let's look at some of that.
So, Joe, I mean, if you look at the labor market, we had a jobs print that came out earlier this morning and showed a couple interesting bits of data. One of those it just showed the jobs were created in the prior month. But the one thing that we noticed was the month of June was revised further downward and actually turned negative for the month. So June was the first time in a long time, really, since COVID, that we've had negative job growth. And we've been talking about this for a number of months. And there are a number of things that are driving that. But, the other side of the labor and the hiring is the open jobs numbers. And you can see that this number continues to move lower. So if you look back to where the data started, we pulled it from 2019. You had around 7 million open jobs. It kind of hovered between 7 and 7.5. You had the COVID drop, which took us to below 5 million open jobs, but then a very strong rebound. And again, taking us to about 12 million open jobs. At this time, there are about 5 million people unemployed. And so you had over 2 jobs per person. Now you're in the range of, over 4 million people unemployed. You have about 7 million jobs that are open. And again, this will be something that's important for us to continue to watch because it's not just the number of jobs that are important, but the types of jobs as well.
And when you look at that, David, I mean, the phrase that you've heard or read about recently is job huggers, right? And, as you go back to 2021, 22, there was a lot of job quitting and a lot of wage inflation, right? There was huge concern. I mean, we had all of that. Now you have job huggers, meaning people are holding on to their job because there aren't as many opportunities out there. And the reality is we're at this point look like we're late in the cycle. We're at full employment. A 50 to 75,000 a month job growth is probably a decent number at this stage. On the other hand, the last few months are trending below that, right? So now as you turn to what will the Fed do, to me, as I've said over the last few months, I thought they would most likely cut interest rates in September, and here we are. They're going to cut interest rates in 2 weeks, right? Now the question is going to be how many more, and where's kind of that stopping period? And to me, that's near term, maybe some optimism, but then some caution as we look into next year.
Yeah, John, I think there's an important question to ask too is, why is the Fed cutting rates? So typically when the Fed cuts rates, markets move lower after that, because typically it's into a slowing economy, a slowing environment. So, is it for that reason that they're cutting rates because they're concerned about the job growth ahead? Or are they cutting rates because we see that inflation is in line and they're looking to stabilize the yield curve? If it's more of the former, it makes sense to have some protection in the portfolio. And again, that push towards value becomes a lot more attractive, because if you have a price earnings ratio of 12 or 13, there's a lot less for it to drop than a company that may have triple digit price to earnings ratios, which is where a lot of the market has been recently.
Well, David, let's look at the 2-year interest rate, versus where things are. Because my feeling over the last few months, Fed funds right now is around 4.5%. Short-term rates, 1 and 2-year rates have been below 4%. So my feeling has been the Fed could cut 2 or 3 times and just kind of have that normalized yield curve, overall. Now the question is, do you go below that? And here's the 2-year Treasury, and again, look at that recent drop off, as of the last few days. The 2-year Treasury rate is today around 3.4%, below 3.5. And again, generally, as you think about the forward rate, if I could buy a Fed fund short-term note around 4.5%, why would I buy a 2-year Treasury at a full 1% less, whereas I can make 4.5, 1% more? The idea is the market is anticipating a lot of rate cuts ahead. And in general, if you just do the rough math on that, the market's expecting 8 rate cuts over the next year or so to justify buying a less than 3.5% versus buying the short-term Fed funds rate at this point. So it's a challenge overall, and you can see yields have dropped to the lowest level. So again, as you look at expectations, which is the chart we talked about last month as well, each bar is kind of each Fed meeting over the next year and the number of cuts. So you can see over the next year or so, the market's priced in over 6. But again, you go back to that 2-year graph, the market's really closer to 8, at this point is kind of the concern. And to me, it's too early to tell on where things are. Maybe it's a short-term overreaction with short-term rates and other things. We got to see where employment goes from here and other things. Because again, I think that's the challenge, David, as you said, is the Fed going to be cutting, and it's going to be a cause for, concern or panic that they're trying to cut to support the labor market, or are they just normalizing for now to kind of let things ease over time? And we'll see where that plays out. And again, to me, these first 2 or 3 rate cuts shouldn't be that big a deal. But as you cut after 3, 4, 5, 6, 7, 8, that's where there could be some concern that the labor market is really softening or the economy could be weakening. But again, for now, we don't see that, right? The economy is in good shape. Consumer confidence, is strong. Let's talk maybe about some of the impacts, David, with the interest rates falling and maybe some of the benefactors too.
Yeah, John, I mean, 2 areas we've talked about for throughout this year have been international and high dividend paying companies, right? We've also talked about housing as an area that's had a significant slowdown. It's getting more attention from the administration right now, and again, it's an area that we've seen that has struggled. But if rates come down in the near term, and especially if you have the short-term rates coming down, what's going to happen immediately is the money market rates are going to move lower. So cash on the sidelines is going to have to find another opportunity, another way to make money. So on the fixed income side of things, you'll likely see some of that money that people are holding and let's say getting right now 4% in money market. When that number is below 3 and you have 2.5% money market rates, it's just a lot harder to make the income that you need. So naturally, you'll see a lot of those assets flow into bonds. That should have a positive impact and drive bond rates lower. As you look ahead, as you look at other areas, housing is one area that really stands to benefit, really heavily tied to the 10-year rate. Obviously, the Fed doesn't control that rate, but as they cut short-term rates and as there's expectation of lower rates ahead, you could see that 10-year rate move lower further. And credit spreads, that banks are looking at for mortgages are tightening. So you're in a, pretty strong position to see much better interest rates in housing in the coming months. And that could create an area of opportunity because again, as we've talked about, buying a house is kind of the first step in a very long project. You buy the house, you then have to you have to pay some movers, you have to pay some painters, you have to stop by the hardware store to get an item or two, right? And that creates a lot of economic activity, which, trickles through the economy. And so that could be a significant boost. And then the other areas, as we've talked about, international. So, diversifying a little bit away from the US, which has done really, really well, to pick up some value names which have, are looking very cheap right now, and to create a little bit of safety, a little bit of diversification, but also to, take advantage of some of these interest rates moving lower.
Well, and David, as you look at housing, right? I mean, the other thing that you've seen is housing prices have been flattened down a little over the last few months. You have stock prices up, your portfolio is up. So a lot of people have been waiting. As I've said, the last few years, we've basically been in a housing depression as far as activity. So there's an opportunity for many people to take some profit on their portfolio. Now mortgage rates will probably be in the upper fives, mid fives. That's off from a peak of 7.5 or 8, right? Housing prices flattened down, right? You can see a lot more activity there. And same with international, as you said, David. I mean, you look at the two biggest stocks in America right now are NVIDIA and Microsoft. Those two alone are almost 15% of the S&P index. And those two companies, relative to many of the total market capitalization of other foreign stock markets, I mean, the one stock is bigger than many of those. So as you think about the rebalance opportunity, a little bit of profit taking and rebalance to international as everybody's moving, it doesn't take that much money to continue to have good performance, and the relative valuations are still fairly attractive. So again, you could continue to see international as more of a multi-quarter, multi-year cycle ahead. The other thing we continue to see, earnings across the board were solid. I mean, it was really, really good quarter, and outlooks for the most part are solid as well. You continue to see a lot of mergers and acquisitions. There's a lot of activity. IPO markets are picking up. So on the one hand, to me, I think near term, you could see the markets continue to move up. But as we, look 6 to 9 months out, that's where, continuing to be diversified and taking profits is likely going to be a path we continue to recommend and move toward over the next few quarters ahead. So with that, I'm going to thank you for tuning in this month, and we'll touch base in October.
Thanks.